The fragile promise of early savings banks. It began with a simple hope, an idea that ordinary people, not just wealthy merchants or powerful financiers, could shape their own financial futures. Small institutions emerged across towns and growing cities, offering a place where modest wages could become meaningful security. But beneath that promise lay a delicate balance that few understood, a balance that would be tested again and again. To understand why these early savings banks matter today, we need to return to an America where financial opportunity was unevenly distributed. Industrial growth was accelerating, yet most families lived close to the edge, vulnerable to illness, recessions, or the loss of a single paycheck. Traditional banks served business interests. Credit flowed toward expansion, not stability. And into this gap stepped a new experiment. Institutions designed to protect the savings of everyday workers, not the ambitions of the elite. These savings banks operated on a vision that felt quietly revolutionary. They accepted small deposits, encouraged steady habits, and promised that even a few cents set aside each week could grow into a safeguard against hardship. For many Americans, it was the first time financial independence felt accessible. The idea spread quickly. Factories encouraged workers to enroll. Newspapers praised the movement as a pathway to dignity and resilience. Yet the early promise masked structural vulnerabilities. Savings banks relied heavily on trust. Trust that managers would act responsibly, trust that deposits would remain safe, and trust that the institutions themselves could withstand economic swings. Many were run by civic leaders rather than seasoned financiers. Their intentions were honorable, but their experience varied widely. And as deposits grew, so did the complexity of the decisions these banks were forced to make. The first signs of strain appeared only quietly. A poorly timed investment here, a misguided loan there. Nothing dramatic at first, just small missteps that hinted at deeper challenges. But beneath those challenges lay the emerging fault lines of a system built on optimism rather than regulation, and on goodwill rather than rigorous oversight. These early beats set the stage for a conflict that would soon test the very foundation of the savings bank movement, revealing just how fragile the promise of financial security could be in a nation still learning how to protect its own prosperity. As deposits continued to grow, the quiet strains within early savings banks became harder to ignore. Many institutions, eager to reward their depositors, invested in local projects that seemed safe: mills, canals, municipal bonds. But these choices often reflected optimism more than caution. When revenues dipped or construction stalled, the banks found themselves tied to ventures that could not deliver the returns they had promised. The losses were small at first, but they revealed a deeper truth. Good intentions could not shield these institutions from the realities of risk. Managers felt the pressure more intensely with each passing season. They balanced ledgers that no longer aligned cleanly. They reassured depositors while silently questioning their own decisions. Without formal oversight or standardized practices, each bank operated like an isolated experiment. The success of one offered no guarantee for another. The vulnerability of even a single institution could send ripples through entire communities, shaking confidence far beyond the walls of a troubled bank. Families sensed the unease in small, unsettling ways. A delayed withdrawal, a banker's hesitant tone, a newspaper rumor hinting at overextended investments. These moments fed quiet anxiety, especially among workers who had never before placed their faith in financial institutions. For many, their deposits represented years of sacrifice, coins set aside after long shifts and unpredictable wages. The possibility that those savings could vanish felt like a betrayal, one that shook the foundations of trust the movement relied upon. Political leaders noticed the rising tension, but struggled to respond. Some argued that intervention would undermine the spirit of independence that had inspired the savings bank model. Others warned that without regulation, reckless decisions could endanger the very people the institutions sought to protect. The debate intensified as failures in isolated towns sparked panic in surrounding regions. Each collapse served as a painful reminder that even small missteps carried consequences far beyond the bank's ledger. Meanwhile, more subtle distortions spread through local economies. Merchants extended credit cautiously, worried that customers' savings might not be stable. Landowners hesitated before signing contracts. Even factory owners, a group once enthusiastic about encouraging workers to save, began to fear what might happen if an entire workforce lost faith in its financial future. These early fractures did not yet define the movement, but they were becoming impossible to dismiss. The system's strength depended on stability, and stability depended on decisions made by individuals who had never anticipated the scale of responsibility they now carried. As the pressure mounted, the fragile promise at the heart of the savings bank idea stood exposed, awaiting a moment that would determine whether to survive or unravel under the weight of its own ideals. The pressure that had quietly accumulated within the savings bank movement finally began to reshape the world around it. As more institutions struggled, the cracks spread beyond individual ledgers and into the daily rhythm of community life. What had once been a symbol of hope now carried an undercurrent of uncertainty, and every withdrawal line, every whispered conversation, added weight to a growing sense that something fundamental was slipping out of balance. Inside the banks, managers faced choices that no handbook had prepared them for. Some doubled down on risky investments, believing bold action could restore their standing. Others retreated into extreme caution, limiting withdrawals and refusing new loans, hoping scarcity would preserve their reserves. Both approaches had consequences. Depositors sensed instability in every policy shift, and trust, the fragile cornerstone of the entire system, began to erode with alarming speed. The conflict sharpened as economic cycles turned against the weaker institutions. A slight downturn in local industries triggered delayed payments. Municipal projects that savings banks had financed missed deadlines or defaulted altogether. With every setback, the bank's balance sheets tightened and the buffer separating solvency from collapse thinned. Communities felt the tension in real time. A failed project meant lost jobs. A delayed interest payment meant another family questioning the safety of its savings. The fear rippled outward, touching every sector built on confidence. At the same time, public frustration grew more visible. Workers who had been encouraged to deposit small portions of each paycheck now wondered why their sacrifices were being jeopardized by decisions they never understood. In some towns, angry crowds gathered outside bank doors demanding answers. In others, silence spread like a warning, as families discouraged neighbors from depositing a single cent more. Each reaction chipped away at the movement's sense of unity. Political leaders, once cautious, now felt compelled to take sides. Reformers argued that the only path forward was oversight, uniform rules, reporting standards, and protections that could prevent reckless investments. Their opponents countered that regulation would smother innovation and erode the local character that made savings banks unique. The debate intensified, turning legislative chambers into battlegrounds where the fate of the entire movement hung in the balance. The conflict reached beyond finance. Schools postponed expansions because funds held in local banks were suddenly uncertain. Hospital projects slowed. Charitable organizations lost access to money they had entrusted to institutions that no longer seemed stable. Each disruption revealed just how deeply embedded savings banks had become in the fabric of community life, and how vulnerable that fabric was when trust faltered. The stakes rose with every passing month. The savings bank model had promised empowerment and security. Yet now, the very mechanism designed to protect ordinary people was becoming a source of fear and instability. The nation stood at a crossroads, sensing that the next failure might ignite a wave of panic capable of reshaping everything the movement had built. The build-up was complete. The fragile promise that had once inspired a generation was about to face its most defining test. A moment when ideals, ambitions, and hard realities would collide with consequences no one could ignore. The breaking point arrived when a cluster of savings banks, already weakened by years of quiet strain, failed almost simultaneously. News spread with unsettling speed. Families who had trusted these institutions for years rushed to withdraw what remained of their savings, only to find locked doors and empty assurances. The movement that had once promised dignity and hope now faced a reckoning defined by fear, frustration, and profound loss. Communities felt the shock immediately. Projects funded by savings banks collapsed overnight, leaving unfinished bridges, idle workers, and municipalities scrambling to fill widening financial gaps. Local businesses that had depended on steady deposits found themselves cut off from credit they once considered reliable. Every shuttered branch symbolized not just a failure of an institution, but the unraveling of trust that had taken years to build. Politicians moved quickly, compelled by public outcry and the visible unraveling of local economies. Reformers argued that the collapse proved what they had warned all along, that goodwill could not substitute for structure, and that protecting ordinary citizens required safeguards the early movement had never implemented. Their opponents, now on the defensive, struggled to justify a system that had left so many vulnerable. The debate that followed was fierce, but the momentum had shifted. The need for oversight could no longer be dismissed as a threat to independence. It had become a necessary foundation for survival. In the aftermath, the savings bank movement transformed. Laws were drafted. Minimum capital standards were introduced. Reporting requirements tightened. Oversight bodies emerged to ensure that no institution handling the dreams of working families could stray unchecked into dangerous territory again. The original vision, to give ordinary people a safe place to build their futures, endured, but it was now rooted in lessons born from hardship rather than hope alone. From a distance, the crisis seemed like a financial event, but for the families who lost their savings, for the workers who depended on these banks to protect their sacrifices, it was deeply personal. The collapse revealed a truth that reshaped the nation's understanding of financial security. Trust must be earned, protected, and reinforced by structures strong enough to withstand both ambition and error. Looking back, the fragile promise of early savings banks marks a turning point in the shaping of America's financial landscape. It showed that empowerment requires not only opportunity but protection, that optimism must be paired with responsibility, and that the stability of a system depends on more than good intentions. It depends on the safeguards we build to honor the faith people place in their institutions. Sometimes the smallest shift in perspective becomes the beginning of a new future.